Welcome to the Deep Dive. Today, we are cracking open the latest financial results and strategic plans for one of the largest communication tower companies in the world, Indus Towers.
That's right.
We are specifically zeroing in on their second quarter, which ended September 30th, 2025. That's Q2 of their fiscal year, 2026.
And this deep dive well, it's really necessary because the official reports, they present a pretty compelling, almost contradictory picture.
Yeah.
The mission today really is to understand that core paradox that defined the quarter. How did Indus Towers manage to report a jump in consolidated revenue, nearly 10% year on year, while their reported profit, the profit after tax, actually fell sharply by over 17%?
Exactly. It's confusing on the surface. We have to look beyond just the domestic financials, the accounting adjustments, and importantly, we also need to dissect their ambitious new strategy. It's multi-market,
A big one.
a significant, imminent expansion into the African continent.
It's a fascinating study in corporate decision-making, really. We're watching a company that is, simultaneously navigating these massive domestic headwinds. Chiefly, that critical customer concentration risk that has, frankly, dogged them for years. And at the same time, they're executing this aggressive global growth strategy and somehow maintaining core operational excellence.
So this discussion should arm you, the listener, with the knowledge to look beyond those maybe scary headlines and grasp the true underlying performance drivers of Indus Towers.
That's the goal.
Okay, let's unpack this, starting with the raw numbers. Consolidated revenues for the quarter. They came in strong at ARA's 8,188 crores. That's that healthy rise, 9.7% year over year.
Yeah, pretty solid top-line growth there. You can see it's primarily driven by adding new tower infrastructure, more sites, more revenue.
It is solid. But then comes the headline, shocker. Reported consolidated profit after tax, PAT, dropped 17.3% down to AR's 1,839 crores.
And that's the number that makes investors, immediately react with alarm. What went wrong? But this is really a classic case where you absolutely need to look closer. You have to compare the adjusted performance versus the reported performance.
Okay, I understand there's an accounting reconciliation needed, but, for the average person just looking at the numbers, a 17% profit drop is still pretty jarring. How do we reconcile that huge divergence, healthy revenue growth, and this profit plunge?
Right. So the reported decline, it's largely accounting noise. It's created by the, frankly, highly unusual comparison quarter from the previous year.
Yeah.
Management was pretty quick to clarify this. This Q2 FY26 included a write-back of Rs 195 crores in provisions for doubtful receivables. That's a positive thing, right? They collected some money they thought was lost.
Okay, good.
However, the prior year quarter, Q2 FY25, that comparison base included a far, far larger, really a one-time write-back. It was Rs 1,080 crores related to collecting a massive chunk of overdue receivables.
Ah, okay. So the comparison base from last year was artificially inflated, massively inflated, actually, due to this huge one-off cash infusion from collecting old debt, something they weren't going to repeat this year.
Precisely. That huge gain last year made the current quarter look, well, disastrously weak just by comparison. But when you adjust these large one-off items out,
Picture changes.
completely,
Wow.
adjusted profit after tax, or PAT, actually grew by a healthy 18.6% year on year. And maybe even more importantly, EBITDA, which is that core measure of operational earnings, grew 14.9%.
Right.
So this confirms that the underlying operational profitability of the business is, in fact, quite robust. It's expanding, actually, despite that deceptive headline PA figure.
Okay, that clarity helps tremendously. Now let's shift gears a bit, away from profitability towards cash flow. Adjusted profits look strong, okay, but profit and cash, they're two different things, aren't they?
Yep.
While the profit and loss statement looks healthy on an adjusted basis, what actually happened to the cash flow? Because we saw a massive drop in operating free cash flow, down 59.2%, and free cash flow, even worse, down 79.4% to just Rs, 296.4 crores. What's driving this really significant cash squeeze?
You've definitely hit on a critical tension point there. This cash compression, it's rooted in two main areas, and both reflect very high investment activity. First, significantly higher capital expenditure, CapEx. It was up 68.6% year on year, totaling Rs 2,558.7 crores for the quarter.
Wow, that's a huge jump in spending.
It is. And this CapEx surge, it's being driven almost entirely by business requirements. Higher tower rollouts to meet demand, customer-driven network upgrades, think 5G installations, battery system additions. that kind of stuff.
So they're essentially just pouring money back into the ground, into the infrastructure for these high-growth projects. Heavy investment.
Exactly. They're in a heavy investment cycle right now. The second factor driving down cash flow is more operational. There was a bit of a timing gap in collections during the quarter, which
Ah,
resulted in a sequential rise in trade receivables. So the cash was earned from services rendered, but it hadn't fully converted into, physical cash in the bank by the end of September.
got it. So that should hopefully normalize a bit in the coming quarters as collections catch up.
That's the expectation, yeah.
Yeah.
Once those receivables are collected, the cash flow picture should stabilize somewhat.
Okay, let's pivot then to the core operational health. Operational metrics, things like tower utilization, tower growth, they're really the bedrock for a company like Indus Towers. What do the capacity and expansion numbers tell us about the fundamental strength of their platform?
Well, the underlying expansion is, it's undeniable. The company is firmly in growth mode.
Okay.
The total tower base now stands at 256,074. That's an addition of over 26,000 towers year on year. That's a lot of new steel.
26,000 towers in a year, that's huge. What about co-locations, the number of tenants on those towers?
Co-locations stand at 415,717 C, multiple tenants per tower, driving efficiency.
And given those massive tower additions, did that rapid expansion dilute the efficiency of their existing assets? I mean, what about that key metric, the tenancy ratio? Did it hold up?
That's a great question. And the closing sharing factor, which is essentially the tenancy ratio, remains highly stable. It's at 1.62 times per tower.
Impressive.
Yeah, the fact that they can add 26,000 new towers and maintain that stability, it reflects continued strong utilization of their infrastructure, both old and new. Like the CEO said, continued tower additions are underpinning the steady performance.
Continued performance despite what the sources described as, well, a brutally challenging quarter operationally. Let's talk about the weather. It sounds like it was pretty extreme.
Oh, absolutely. The quarter saw, and this is a quote, one of the most challenging weather conditions, including devastating floods due to a prolonged and unforgiving monsoon season.
Devastating floods. That must have created immense pressure on just keeping the sites running, site access, power generation,
Huge pressure across their entire network footprint.
maintaining network stability despite something like that, devastating floods. It's an incredible feat of logistics engineering. But I imagine that kind of operational resilience must have come at a pretty steep price.
It certainly did. They did manage to maintain network uptime at an, quote, industry-leading 99.965%, which is remarkable under the circumstances.
Yeah.
But, as you said, this reliability was expensive. The severe monsoon resulted in way more electricity outages, much longer power backup requirements,
Yeah.
and that caused diesel consumption to increase 3% year on year compared to Q2 last year.
The diesel costs.
Yeah, that sharp rise in input costs negatively impacted their energy margins. They were actually negative 4.8% for the quarter because of it.
So, okay, they successfully managed a major weather crisis, kept the network up, but took a hit on efficiency, especially energy costs. What are they doing longer term to maybe offset those rising energy costs and also handle these massive CapEx demands, making the network smarter, more efficient?
Yeah, their focus is squarely on structural, long-term sustainability and efficiency improvements,
Yeah.
not just patching problems.
Like what?
Well, on the green initiatives front, they added 3,900 solar sites this quarter alone. That brings their total solar-powered base close to 36,000 sites now.
36,000 solar sites. That's substantial.
It is. And they were also aggressively transitioning their massive CapEx spend towards lithium-ion batteries. These offer a significantly lower total cost of ownership over the life of the asset compared to the older legacy lead-acid systems.
Right. So replacing old power sources with newer, more efficient ones, that should require less maintenance, hopefully less diesel in the future, hedging against those future commodity price spikes.
That's exactly the strategy. And beyond hardware, they are also leveraging automation and AI. Management specifically mentioned this, using it to maintain their pole position by enhancing efficiency and service quality across their, frankly, vast network.
And does this show up in workforce productivity?
It does seem to. We see hard evidence there. The number of macro towers per employee rose to 71. That's a 14.5% increase year on year. So showing definite efficiency gains from maybe a stable or even slightly smaller operational personnel footprint, managing more assets.
Okay, let's talk strategy now. This feels like the really big news out of this quarter, this major pivot. Indus Towers is making a major official strategic shift toward international markets. What's the scope of this global expansion?
Yeah, this is significant. They have formally approved a strategic entry into the African market, and they're targeting three specific countries to start with: Nigeria, Uganda, and Zambia.
Nigeria, Uganda, Zambia. Okay. Why Africa specifically? Are they just looking for, general diversification away from India?
It seems more pointed than just general diversification. The CEO explicitly stated that Africa is, and I quote, a virtue where India was a few years back, meaning it offers a massive opportunity for rapid initial build-out and growth, similar to India's trajectory maybe 5–10 years ago. So this move is definitely a strategic step towards supplementing long-term growth, but also, crucially, diversifying their revenue base away from the high concentration and, let's face it, the domestic regulatory risks associated with the Indian market.
That makes a lot of sense. Diversification plus a high growth story. Now, the African telecom market is often seen as, high risk, high reward. What's the game plan for actually entering these markets? Are they buying existing tower assets or building everything new from scratch?
Good question. The initial phase, they stated, is dedicated to organic growth.
Building new.
Building new towers, yes. The stated goal is to first understand the on-ground operations and build a scalable operating model that's tailored specifically for African conditions, but using their Indian expertise. Now, they will absolutely consider inorganic growth, acquiring existing assets, if the right opportunity comes along later. But they want to lay their own groundwork first.
Building high-quality new infrastructure in developing markets, that sounds inherently expensive and frankly quite difficult. Why are they confident they can succeed where maybe other global tower firms might hesitate or have struggled?
Well, their core competitive differentiation, they believe, hinges entirely on leveraging their enormous scale from India and replicating their expertise there. Specifically, building high-quality but highly cost-efficient infrastructure that's tailored to local conditions, climate, population density, and ensuring that best-in-class service reliability they're known for in India.
Okay, efficiency and reliability. But isn't there a bigger advantage?
There is. Their absolute key advantage, and they highlighted this, is the visibility of an anchor customer right from day one.
Hearty Airtel.
Exactly. They are leveraging Party Airtel's deep-rooted and established operational position across those specific African markets: Nigeria, Uganda, Zambia. This immediately de-risks that initial build-out phase quite significantly.
Yeah, having that guaranteed first tenant makes the initial investment much, much safer than if they were just entering cold looking for customers. But they must be fully aware of the known pitfalls, particularly in a market like Nigeria. I'm thinking specifically about currency volatility, difficulties repatriating profits. Those are common concerns.
Oh, definitely. And they addressed this directly during the earnings call. They acknowledged the known risks in Nigeria, stating they are, quote, cognizant of the risk.
Okay, so they know. What's the mitigation strategy?
Their strategy relies heavily on leveraging their anchor partners, Party Airtel's established presence, their local know-how, and potentially their currency hedging strategies specific to those regions. The aim is to minimize the impact on dividend upstreaming and profit repatriation. They're not going in blind, basically. They believe they have a plan.
What's the timeline on this pretty substantial global shift? Is this a 5-year plan or?
Much sooner. They are targeting initial deployment, actually starting the build to commence within the next 3 to 6 months.
Oh, wow.
So this is not some distant strategic goal. This pivot is happening, like, right now. Boots on the ground soon.
Okay, let's pivot back now to the other side of the risk equation, the domestic sphere. We absolutely have to discuss the significant customer concentration risk. It came up again. The auditor's report raised an emphasis of matter regarding one of their largest domestic customers. What exactly did the audit document tell us about that situation?
Yeah, this remains a critical point. What's central here is that disclosure from the auditors about the material uncertainty related to the going concern status of one of the largest customers.
Material uncertainty regarding going concern. That's one of the strongest phrases an auditor can use, right? It indicates significant financial strain for that customer.
It really does. It signals serious doubts about the customer's ability to continue operating without significant changes or support.
What specifically is that customer survival dependent upon, according to the sources?
Well, the sources explain that this customer's ability to settle its, frankly, substantial liabilities is dependent on several major external factors happening.
Such as?
Things like obtaining support from the Department of Telecommunications, the DOT, regarding that complex AGR matter. Also, successful equity or debt fundraising out in the market. And ultimately, just generating positive cash flow through improved operations. A lot needs to go right for them.
Okay, so given this intense material uncertainty, How is Indus Towers protecting itself financially? What are they doing about the massive risk of a sudden non-payment or even a default from this major customer?
Right. Well, Indus continues to recognize revenue for the services they're providing because, critically, the customer is currently paying an amount that's equivalent to the monthly billing.
Yeah.
So cash is coming in for current services.
Okay, that's important.
Very important. However, their main proactive protection measure is found in their accounting policy related to this customer. They're specifically not recognizing something called the Revenue Equalization Asset, or REA, on account of the straight lining of lease rentals, precisely because of this customer's stressed financial condition.
Okay, that sounds incredibly technical. Revenue equalization asset. Can you maybe clarify why not recognizing that asset is actually a protective measure for Indus Towers? What does that mean in simpler terms?
Sure, let me try. In essence, under accounting rules, long-term leases like tower leases often have payments that might change over time, but the revenue has to be booked evenly or straight-lined over the whole lease term.
Okay.
The revenue equalization asset, the REA, basically represents the future revenue that the accounting rules say they are technically owed based on that straight lining, but that they haven't actually received cash for yet. It's like an IOU created by the accounting standard.
Got it. Future recognized revenue, not yet cash.
Exactly. So by choosing not to recognize this REA asset for this specific financially stressed customer, Indus is opting not to book those future, not yet due revenue streams onto their current books. It effectively shields their current profit and loss statement and their balance sheet from potentially uncollectible long-term income from that specific tenant if things go bad later.
Okay. It's a transparent way of kind of ring-fencing their current financials against that specific future risk. Makes sense.
Precisely. It acknowledges the risk without immediately impairing current results as long as the monthly cash keeps coming in.
Okay. Finally, let's bring it all together. What does this strong yet clearly volatile performance, the heavy CapEx spend, the big Africa bet, and this ongoing major customer risk, what does it all mean for shareholders, specifically regarding cash returns, like dividends? Is anything coming back to them?
Well, the management did confirm that the board remains committed in principle to distributing cash to shareholders, so the intent is there. But they were also very clear that the timing of any actual cash return still remains targeted for the end of the financial year, which is Q4 FY26. So not immediately.
Why the continued delay, though? I mean, given the underlying business is generating strong adjusted profits, as you explained, why not reward shareholders sooner? What's the holdup?
It really comes down directly to that central tension point we've been discussing throughout this whole conversation. First, clarity on that big customer situation, the AGR issue, their financial health, that remains the primary known hurdle influencing the timing.
Okay, the customer risk.
Yes, but equally important right now is the liquidity requirement. It's driven by that massive CapEx we saw in Q2, and which likely continues. They are pouring billions of crores into 5G upgrades domestically and now into this brand new African market build-out.
Right, Africa won't be cheap up front.
Exactly. So managing that huge CapEx demand, alongside mitigating the lingering customer risk, it just requires maintaining a pretty strong liquidity buffer for the time being. Prudence dictates holding onto the cash for now.
Okay, so wrapping this up, what does this all mean for you, the listener? What are the key takeaways?
Well, we've seen a story of really strong operational execution, driven by domestic 5G expansion and just massive network build-out.
Yeah, the core operations look solid.
And that's successfully masking the volatility caused by those one-time accounting adjustments from last year, and also the effects of these massive cash-draining CapEx outlays happening right now.
And we've established that the underlying operational profitability is extremely healthy, right? That adjusted PT up 18.6%. And the company is aggressively pursuing both expansion now over 250,000 towers, 256,074, and efficiency hitting 36,000 solar sites.
But their biggest move, arguably, the expansion into Nigeria, Uganda, and Zambia, it really shows they are making a strategic bid for significant global growth, looking far beyond their current domestic market and its associated challenges.
Indeed. Their ability to successfully launch that African venture, it really hinges entirely on leveraging their massive Indian scale and cost expertise. And of course, using Bharti Airtel as that crucial foundational anchor tenant. Yeah. The big challenge, however, remains that difficult balancing act. Managing the significant financial risk tied to their largest domestic customer, while at the same time pouring funds into this aggressive global expansion.
The tension between those two strategic imperatives,
Hmm.
risk mitigation at home versus pursuing potentially explosive growth abroad, that's really the central issue defining their immediate future. It's a tightrope walk.
So, for your final provocative thought today, given Indus Towers' clear strategic shift toward aggressive international growth in Africa and the concurrent need for massive domestic capex deployment for 5G, how does their continued commitment, even if delayed, to distributing dividends in Q4 truly balance against the immediate pressing need to maintain the liquidity necessary to fully mitigate the ongoing material uncertainty surrounding that major domestic customer?
Hmm.
This tension point between risk management, funding growth, and shareholder returns, that's what will truly define their success and likely their stock market journey over the next fiscal year. Something to definitely keep watching.